why you don't actually have a risk strategy. Most investors believe they have a risk strategy. They believe they manage downside. They believe they are diversified. They believe they are disciplined. But in reality, most investors do not have a risk strategy. They have a risk intention. And intention collapses under stress. There's a fundamental difference between saying, I will manage risk, and designing a structure that manages risk automatically. As Daniel Kahneman demonstrated in Thinking Fast and Slow, decision-making under emotional activation shifts from analytical processing to fast reactive judgment. Under stress, analytical thinking weakens and instinct dominates. Markets do not become dangerous because prices fall. They become dangerous because falling prices activate fast thinking, and fast thinking negotiates with risk. Volatility does not create risk, it reveals it. In calm markets, risk feels abstract. Drawdowns feel theoretical. Diversification feels sufficient. Leverage feels manageable. But volatility does not test theory. It tests structure. Consider this. The S&P 500 has experienced drawdowns of 30 to 50% multiple times over the last century. The NASDAQ fell nearly 80% after the dot-com peak. Even diversified portfolios in 2008 experienced correlated collapse due to systemic liquidity risk. Most investors intellectually know this. Very few structurally prepare for it. This is what Nassim Taleb calls fragility. Fragility is not exposure to volatility. Fragility is exposure to volatility without convex protection. If a 20% drawdown forces you to change your plan, you never had a risk strategy. You had a volatility tolerance assumption. Diversification is not automatically a risk strategy. Harry Markowitz introduced modern portfolio theory, but even he later acknowledged that correlations are unstable under stress. Assets that appear uncorrelated in normal regimes often move together during crisis regimes. This is known as correlation clustering. Owning 10 assets that fall together is not diversification. It is concentration disguised as complexity. True risk strategy measures correlation under stress, liquidity risk, exposure to systemic factors, tail risk. Most portfolios are factor concentrated without realizing it. Tech-heavy portfolios in 2021 felt diversified. In 2022, they moved as one. Diversification without scenario analysis is decoration. Undefined downside is hidden leverage. Most investors define upside precisely. They build spreadsheets, they calculate target returns, they project growth curves. But downside is left vague. I can handle volatility. I'm long-term. I'll reassess. Hope is not risk management. Professional risk frameworks define maximum position size, maximum portfolio exposure, maximum drawdown, maximum loss per period. Action triggers. Without predefined triggers, behavior becomes adaptive in the worst way. And adaptive behavior under fear becomes destructive. Richard Thaler's work on behavioral finance shows that losses are felt approximately twice as intensely as equivalent gains. This is loss aversion. Without predefined exit structure, loss aversion distorts execution. The investor waits longer than planned, reduces discipline, justifies delay, extends time horizon, negotiates with reality. Risk is not purely mathematical, it is behavioral. Most people define risk as volatility, but volatility is not risk. Volatility is the cost of participation. Risk is behavioral collapse under volatility. If you cannot sleep because of a position, it is too large. If you check price every hour, it is too large. If a small move changes your emotional state, it is too large. Position sizing is not a technical variable, it is a psychological regulator. This aligns with the concept of risk of ruin. Even profitable systems fail if exposure is too large relative to capital. The Kelly Criterion demonstrates that optimal growth collapses if overbetting occurs. Overbetting feels aggressive. Underbetting feels inefficient. But overbetting increases fragility exponentially. Leverage amplifies illusion. Hyman Minsky described financial instability as endogenous. Stability breeds instability. Periods of calm increase leverage. Increased leverage increases fragility. Fragility creates crisis. Investors extrapolate recent stability, they increase exposure, they reduce hedging, they concentrate positions, Then a shock occurs. And what looked stable was actually leveraged stability. Most catastrophic losses are not caused by ignorance. They are caused by undefined limits. Time horizon is also a risk variable. Many investors claim long-term strategy, but they do not allocate capital consistent with long-term endurance. If you cannot tolerate 3 to 5 years of underperformance, you do not have a long-term strategy. You have long-term language. Time horizon mismatch is one of the most common structural weaknesses. Capital allocation must reflect psychological capacity. Otherwise, the strategy collapses mid-cycle. The real definition of a risk strategy is simple. It is not about prediction. It is about survival. It defines before entry how much capital is exposed, how much can be lost, what invalidates the thesis, what action is automatic, what cannot be negotiated. Structure eliminates negotiation. Negotiation under stress destroys capital. Markets do not destroy investors who are wrong. They destroy investors who are overexposed when wrong. Survival enables compounding. Compounding requires longevity. Longevity requires limits. Ask yourself, can I quantify my maximum acceptable portfolio drawdown? Can I define my maximum exposure to one factor? Can I explain my action if correlation spikes? Can I describe my leverage ceiling? If these answers are not written, quantified, and enforced, you do not have a risk strategy. You have a belief. Beliefs are flexible. Markets are not. If you remember only 3 things from this video. First, intention is not risk management. Predefined structure is. Second, diversification without stress analysis is false protection. Third, compounding requires survival. Survival requires limits. Markets do not punish mistakes, they punish undefined exposure.